right now, our forecast is for unemployment rate to rise to 4.5% at the end of this year. And that would comfortably trigger the famous SOM rule for identifying a recession. And so based on that, that would indicate, a high likelihood of recession. However, to fully make this a recession call, one actually has to further have unemployment rate climbing um, to mid fives for it to be consistent with past recession pattern. But nonetheless, I think that 4.5% unemployment rate would feel like a recession for most Americans. And I think regardless of whether NBER will declare a recession, in 2025 or 2026, it's really immaterial. It's the fact that most Americans would feel like the economy is in a recession.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The U.S. economy appears to be slowing down. Final Q1 GDP growth came in at just 1.4%, and of this recording, Q2 GDP is currently estimated to be a little better at 1.5%. Retail sales for May, the most recent data we have, only grew at 0.1%, and unemployment is starting to tick up, rising last week to 4.1%. Now, none of these stats are particularly worrisome on their own, but together, are they signaling rockier economic times could lie ahead? To find out, we have the good fortune to talk today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economic Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Happy to be here, Adam.
Hey, it's a super pleasure to have you on the channel. First time I'm interviewing you, getting to meet you virtually. Thank you for coming on. Been hoping to have you on here for a good while. And I have a lot of questions here for you, Anna. So we're going to try to get through as many of them as possible in the time we have here. But very, very excited to get your opinion on what's happening at the macro level right now. And if we can, let's just start with the question I like to ask all my guests at the beginning of these interviews. It's an intentionally broad question, but I think it's instructive. What's your current assessment of the global economy and financial markets?
I think the greatest risk to global financial markets are things that investors haven't yet fully priced into. And one of them is the geopolitical risks between US and China, particularly with the looming US presidential election in November. Currently, odds are showing that former President Donald Trump is likely to win a term, to be the winner. And if Donald Trump were to become the U.S. president, I think likely we are going to see a further deterioration of U.S.-China geopolitical tensions. And in fact, looking at the U.S. stock market, for example, one of the stocks that has been powering the brisk increase in S&P 500 over the last 2 years is NVIDIA. And if people really look into the supply chain relationship of NVIDIA, you will see that the two most important supply chain provider for NVIDIA chips is actually Taiwan and Israel. And those two countries are in the middle of the two flashpoint of global geopolitical tensions. And so if Trump were to be reelected, one could expect that the US could possibly impose more tariffs on China or even in other parts of the world, which could further challenge the supply chain resiliency of NVIDIA. And I think that the US market simply hasn't been focusing too much on supply chain issues of NVIDIA. And I think that judging how NVIDIA alone has been supporting the stock market run we've seen in the last year, that could truly be a risk. And if NVIDIA is going down, I think the whole market is going down. So that's one risk. And I think the second risk is, of course, what the Fed will do next. And currently, pretty much nobody is pricing in for the Fed to raise interest rate. For the Fed to raise rates next year is still a fringe risk. Um, but I think that if Trump were to be reelected, there is a higher chance that financial markets would price in a probability of rate hike in 2025 and 2026 in response to potential tariff increase. Some of the models, economic models that are widely used, have shown that a 10% additional tariffs on the rest of the world, as Trump has recently proposed, could raise core PCE deflator by at least another percentage point. Now, put aside whether the model is right or not, the important thing is whether the Fed staff who are briefing Chair Powell on this issue believe so, and whether the FOMC do take onto that forecast that inflation is going to rise if they see a Trump proposal of 10% tariff increase, then that could lead to an increase that could actually lead to a rate hike. And I think that again, it's these risks that nobody is currently pricing in that could serve as a threat to the stock market run we have seen so far in the past year. So I will stop there.
All right. Well, that's really interesting, which is, you're right. I really haven't heard much recently about people saying Trump equals tariffs. So if Trump gets elected, tariffs come into the system, and then this is how tariffs are going to impact the economy versus the baseline that we have right now. Obviously, and this isn't a partisan comment, but obviously, given recent events, the performance of the debate, the probability of Trump becoming elected in November has gone up. If you look at the polls and the prediction markets. So you're right. We should be saying, all right, well, look, if there is a regime change and Trump comes in and we have this different economic policy, what are the knock-on effects of that are going to be? And I agree with you. I don't really think there's anybody right now that has Fed rate hikes in 2025 on their dance card right now. So that would be a pretty big game changer. I'm trying to resist this early in the conversation, drilling into NVIDIA with you. So I'm going to try to push that off to a little bit later, because I think the supply chain things that you talked about are interesting. I also just want to get your thoughts on NVIDIA's current valuation. I know you're an economist and you're less a stock analyst and whatnot, but at some point, assets can get to a level of valuation or overvaluation where the prices run up beyond their true value. And I'd love to get a sense from you as, hey, if NVIDIA corrects for whatever reason, supply chain, disappointing forecast, market just decided that it's just gotten too far ahead of itself, what that will mean for the stock market. I did hear your point that if NVIDIA goes down, it's going to take the market down with it. So I do want to get to that. But before we do, I want to stay at the policy level for a minute. So right now we have an interesting time in the macro environment world where we're coming out of COVID, where you can say that monetary policy and fiscal policy were really operating in tandem, right? They had this united goal of let's rescue the economy by stimulating it as much as we can. Love to get a sense from you if you think the level of stimulus was necessary, or maybe if we overdid things. Curious if you have an opinion on that. But right now we have this scenario where on the monetary side, we have adopted a much tighter policy than we'd had in past decade plus, right? Where the fiscal side has continued, so the monetary side is kind of pumping the brakes pretty hard. Fiscal side has been still foot solidly on the gas. And so I'm just wondering, is your opinion that they are now at odds with one another, and the Fed is feeling increasingly frustrated with the fiscal side because, hey, you're kind of undoing a lot of what I'm trying to accomplish here? Or is this more coordinated than somebody from the cheap seats like me may be able to understand?
No, Adam, I think you're completely right. So they are at odds with each other. And while Jay Powell always publicly say he doesn't want to comment on fiscal policy, he did mention a couple times that on the current trajectory, fiscal debt is not sustainable. Um, and I think this is the first time that we see such a large deficit at a time where the economy is supposed to be doing really well. So if the fiscal deficit is running at 5 or 6% when GDP growth is, above 2%, then imagine what that deficit should be should the automatic stabilizer kick in a time of recession. It
Hmm.
means that the fiscal deficit could easily grow to 7 to 10% if there were to be a recession in the next 2 years. On top of that, based on our forecast, we do see that in the next 10 years, interest payments will gradually account to be each year to be at least 4% of the GDP every year. So, ideally, when you run a large fiscal deficit, interest rate would also be very low, such that the financing cost of that fiscal deficit is low. And this usually happens in a recession, right? In a recession, the Fed cuts rates. Therefore, when you issue more debt in a recession, that does not necessarily blow up your fiscal calculus. But when the Fed is trying to raise rates and you're busily issuing all these treasury debt, that is not that means that you're running pro-cyclical fiscal policies. So yeah, they're definitely odds. And when I was the White House Council of Economic Advisor from 2019 to 2020, I remember the debate in terms of the design of the CARES Act. One thing we did look at is the expansion and the provision of unemployment benefits, given the unprecedented shutdown. The idea is that we need to aggressively expand the UI claims so that people, because they're forced not to work, that they could be paid. But I remember even in 2020, early part of 2020, my colleagues did find out that the expansion of the UI claims covered beyond the existing income of about, I seem to remember 50% of the population. So even then, we already recognized that the expansion and the UI benefits with the first fiscal package was very generous. And on top of that, there was the PPP program to help small business stave off from bankruptcies. And that program has also been very successful. So the question becomes, we had a couple more fiscal stimulus package after the first one. From my perspective, the first fiscal stimulus in 2020, the CARES Act, is really necessary. But by December of 2020, when the economy has already made sort of like a V-shape recovery,
Hmm.
that additional part, according to our calculation, further cost, Americans are actually quite rational. When their calculus shows that it's just better to receive this exhaustive UI benefits as opposed to working, you go for it. And I think in the subsequent 2 years since 2020, and I've been with Bloomberg Economics for 3 years now, and I remember in the fall of 2021 when the UI claims, pandemic UI benefit expired in September, my prediction for the non-farm payroll then was that there would be a sudden surge of uh, workers coming back looking for a job in the economy. And at that point, the first release of the jobs report didn't confirm my prediction, but subsequently, after all the revisions came in, it did exactly corroborate my suspicion that there is the moment that these pandemic UI claims expired, there's a surge of uh, workers rejoining the economy. So I think incentives, what the lesson of pandemic policy is that workers do respond to incentives.
So I think there's a lot of people watching this video who would say, yeah, like we hear about all the PhDs that, the Fed has and that are on the fiscal side as well. And man, we probably could have told them, yeah, you pay people, enough not to work. They're not going to work. You take that away. When it runs out, they're going to come back, right?
Yeah.
So I kind of, correct me if I'm wrong, but I kind of get from your response there a tone of, hey, we obviously had to do something because we shut the economy down, right? We just couldn't, we couldn't just leave everybody out there in the cold. And we put together an initial package that we thought was pretty generous and would do the trick. But then we just kept, and this was mostly
Yes.
on the fiscal side, we just kept putting more and more and more on that. And lo and behold, we've got this big deficit spending you referenced earlier, but we had the surge of inflation that is, we're still trying to clear through the system. So I think you would say we did too much. Let me ask you this, because I know people watching, there's some people watching that are probably going to go nuts in the comments about it, something you just said, where you said, we did the PPP loans and that program was successful. Um, there seems to be a lot of reports that have come out since that a lot of that money was not well accounted for, and a lot of it was used for not its intended purposes. And it's looked at by many as kind of a big giveaway, to a certain extent. I know when you're responding to an unforeseen emergency like that, whatever you do isn't going to be 100% efficient. But what's your general assessment of that PPP program? Was it good enough and we just have to swallow it, or are there things that in retrospect we should have done differently?
Yeah, I think that, so in real time, as the government was administering the PPP, I was with my colleagues at CEA and Treasury, we were looking at the immediate real-time impact on how it prevented immediate bankruptcies. So typically in recessions, you see a surge of Chapter 11 and bankruptcy, and at that time we had weekly bankruptcy data, and we showed that there is significantly less bankruptcies than had there not been a PPP program. So in that sense, it did its job. But Adam, I totally agree with you that subsequently, uh, I think a lot of investigations have uncovered fraud, and similarly with pandemic UI claims as well. And so I think whenever the U.S. government provide social transfers, fraud will happen. But in 2020 and 2021, the size of those social transfer were so large that inevitably there are indeed larger fraud than
Yeah.
typically experienced. So yeah, but I think at that time so much is unprecedented that in terms of crafting that package, there were a lot of overlapping fiscal transfers. Like for example, the Congress gave more aid to the state and local government that overlap with other fiscal packages. As a result, state and local government also felt very flush for a while. In
Mhm.
fact, many have unused funds even as of last year, which after the debt ceiling settlement that they had to return and claw back. There is just a lot of excess. Let's just say that.
All right. And look, this would actually be a really interesting interview to have at some point, Anna, which should just be to do sort of your forensic deconstruction of what happened, and to be able to talk to somebody like yourself who was there, at the table trying to make these decisions in real time is a really fantastic privilege to have. But also, I'd love to get your thoughts on kind of like, all right, if we had a money quarterback and we knew there was going to be a similar thing tomorrow, what would we do again, and what would we do differently, right? And I guess my last question on this, I'll just take a very short answer, is do you have a sense that do we have better safeguards or better learnings in place this time around, where if we did something on a similar magnitude in the future, we'd have better accountability and better ability to kind of reduce the chances for fraud? Or is it just, hey, government's not perfect, and we haven't learned all that much?
Yeah, I got my PhD from University of Chicago, and I stay true to my roots, which is that I do think that the government is not the most efficient place. And also, dealing with a pandemic is a once in a century thing. The
Yeah.
last time we saw such a huge thing is the Spanish flu. So it is indeed once a century thing. And I sure hope that we won't have another pandemic anytime soon. But I think in another 100 years, nobody would remember the lessons.
Okay.
But
All right.
Adam, I think the key problem of this is that when as a policymaker, you grapple with the imperfection of real-time information. At that
Mhm.
time, everything is closing left and right. Even accessing the bankruptcy data from the courts. Well, people law courts clerks aren't there to file the bankruptcy. Like people cannot go there and file it. Everything is closed down. And so there's this time lag that is amplified by the pandemic nature of the time. And also, talking about the jobs data, revisions are huge, even now, like to be forward looking. We have seen the unemployment rate now rising, but we also have seen the non-farm payroll increase per month, increasing at 220,000 per month in the past 6 months. And however, each month we see a big downward revisions to the jobs data. That
Right.
is the kind of imperfection in the data that in real time information that the Fed grapples with, and they have to make policy decisions based on not really knowing the true degree of the weakening of the economy. And that was similarly what the policymakers faced with in 2020.
Okay. I'm very sympathetic to that in the heat of totally unanticipated massive black swan like COVID was. Um, and it's interesting. So I've got questions here that we're going to get to about the jobs data because I'm very interested to get your thoughts on that. And I think what I hear you saying is something I've heard some other analysts say who talk to the BLS relatively often, which is COVID created such distortions in the data that we laid off tens of millions of people basically overnight, right? And then we tried to hire them back as quickly as possible. So just kind of the bullwhip effect of all that massive data change is still reverberating through the BLS's models to the point where you're saying that they're still suspect today, right? I mean, a huge part of those 200,000 uh, jobs that get added every month in the payroll data are largely attributed by the birth death model, right? And then the month later, they go back and say, yep, we really overestimated, and they whack those numbers down, right? So even though we're years away now, we're still seeing reverberations from that. You're nodding as I'm saying all this, right?
You're exactly right.
Okay. All right. Well, let me hop back on the train of thought here real quick. I'm just going to knock on wood here to your point about something like COVID truly being a once in a century event. I don't think anybody wants to see one come any sooner than at least 100 years from now. Okay, so we were talking about how monetary and fiscal policy are at odds with each other. Um, so that's I guess concerning to sort of the armchair investor because they're like, all right, I don't like the fact that we've basically got discoordination going on amongst our central planners. Um, there's been a fair amount of discussion recently about the debt load, right? So deficit spending leads to the accretion of debt over time. We're now at the point where our debt service costs have really spiked, one, because debts have grown, but also because interest rates are now a lot higher than they were, over the past decade. Um, and people are using this term fiscal dominance. So we're now entering an era of fiscal dominance. And the way in which I understand the term fiscal dominance, kind of at its heart, is um, if you get into an era of fiscal dominance, it means that the Federal Reserve, all of a sudden, its priority number one becomes keeping the debt load manageable, right? Trying to avoid a real debt crisis. And so it has to start abandoning its other mandates. All right, I gotta not worry so much about what happens in unemployment. And I even, if it gets bad enough, we got to forget about inflation because we're just trying to keep the system together here. Are we in an era of fiscal dominance?
I don't think so. And I think the one key reason for that is that the Fed is independent from the other branch of the government. And the Fed does not consider the debt load, the fiscal debt load, when they are making monetary policy. And one key transmission channel of tight monetary policy is through long rates, right? Uh, Unlike other advanced economy, the US is not as much driven by short rates as long rates. Because, in other countries like Canada, like UK, mortgage debt are on floating interest rates. So whenever the government, the central bank raise rates, the economy feels it. Whereas in the US, it is really 10-year yields that
Hmm.
tighten or loosen financial conditions. And I think the mechanism that could prevent this, that checks this fiscal dominance, is whenever the financial market sense that the fiscal trajectory is unsustainable, they're going to bid up the long-term treasury yield. And that long-term treasury yields would immediately dampen the economy. And as it dampens the economy, the Fed will have to um, uh, lower rates, and also inflation, as because of the dampening effect of the long-term yields on the economy, inflation would also slows. So I don't see fiscal dominance being a major risks to the US economy yet. But of course, the key risk is if there's some institutional change to the Fed. If, for example, the Fed were a new Fed chairman after Powell goes, I think in 2026 or
Yeah.
yeah, around that time, if that Fed chairman were to coordinate more with US Treasury, that would be a problem.
Okay. And just to talk about the end of Powell's um, tenure, uh, Donald Trump, at least in the most recent comments I've seen Trump make about Powell, is he wants to get rid of him, even though Trump put him in there. But Trump really can't get rid of Powell until his term ends, right? I mean, it has to be something extremely egregious to remove an acting Fed chair before their tenure ends. Is that correct?
Yeah, I think and I do not have a law degree, but I think it will be extremely hard for him to get rid of Powell. And I would say that in the first Trump term, I already have experience, I've seen firsthand that former President Trump does really loathe Powell, and he tried to get rid of him then, but there's just it's very, very hard. He tried, he, but no, he can't do it. So I would say that, yeah, it would be extremely hard.
Okay. But it doesn't mean, I'm not saying this is going to happen, but it doesn't mean that he couldn't if Trump were to win in 2026, he could appoint somebody that's much more pliable than Powell has proved to be.
It's possible.
Yeah. Okay. All right. Well, look, since we're on the topic here still of policy and inflation, where do you see inflation headed from here? I initially was thinking from your writings that you might think it's heading down if the economy is indeed slowing, but then you mentioned tariffs in your opening intro there. So I don't know. It's not a prediction I'm going to hold you to, but what do you think the trend is here? Powell, and I should say too, on the day we're talking, they were recording. Powell is testifying to Congress today and tomorrow. We don't really have the results of that yet for this discussion, but coming into these meetings, Powell has said, hey, we're actually feeling pretty good that we're seeing the disinflationary trend that we've been hoping for that's going to get us to 2%. I think he's still taking care to say, still want to see more data, not trying to say that we're going to cut rates, this month, because there is a FOMC meeting coming up. But he is singing a more positive tune. So I don't know. What do you think?
Yeah, so if the goalpost is to return the core PCE inflation to 2%, I think the current restrictiveness of monetary policy may not do the job until 2026. It's the I think the evaluation whether the Fed succeed in bringing inflation back to 2% is there has to be a deadline. Is it, can they bring inflation back to 2% by the end of this year, or is it by the end of next year, or 2026, or 5 years later? I think from the Fed's perspective, they want to get it back to 2% before 2026. If that's the goal, I think yes, they could. But if the idea is to bring it back at the end of this year, I don't think so. I think at the end of this year, core PCE inflation would be growing at about 2.8 to 2.9% on a 12-month basis. And in fact, I still see some inflationary pressure in some very slow-moving components that are very important to most Americans. One of them is healthcare. Many hospitals who had seen rising labor costs in the last 2 years, and also they have regulatory issues and not being able to raise prices quickly. I think over the next couple of years, we're going to see either hospitals raising more prices, or they will have to reduce services to narrow, the amount of quality of services and quantity of services to Americans in order to stay on budget. And so I see one potentially slow moving categories that will experience catch up inflation is healthcare. The second is home insurance. I think that
Mhm.
uh, most Americans in the past 30 years are used to when they put in a bid to buy a home and they're given, a monthly payment. You expect that monthly payment to stay the same every month. But this year, I think a lot of Americans are in for a shock when they look at that new, escrow payments from their escrow services, and they're like, oh my gosh, it's like 10% higher, 20% higher. And part of it is home insurances reflecting a combination of higher construction costs, which is has a lagged effect uh, it, to inflation with
Yep.
1 or 2 years lag. And then another part is the climate risk. And, in certain areas like California, Florida, homes are extremely hard to insure with, rising water levels and higher chance of hurricanes and mountain fire. So I think that there are still inflationary, very slow brewing kind of catch-up growth that is being underappreciated by the Fed currently. And interestingly, Adam, when I looked at the inflation cycles over the past 100 years, I find that usually the year-over-year inflation reach a trough after two period of whenever you have a inflationary episode.
Hmm.
Whatever the inflation rate is after 2 years of that episode is where it settles at. And at the end of this year, that's where we would be at the end of the 2 year of an inflationary episode. So I think whatever inflation rate you see at the end of this year is basically the inflation rate that the economy is stuck at. And I think that number is higher than the Fed's 2% interest rate. So I do see, even if the economy is slowing, these slow moving healthcare, home insurance inflation is insensitive to the cyclical nature cycle of the economy. So I think that a very bad situation would be if unemployment were to rise to 4.5% as we forecast, while inflation is it continues to be, stuck in that around that 3% range, then I think Americans would be very angry.
Yeah, I mean, that begins to really feel like stagflation. Um, so let me just ask you this. So you said if unemployment were to rise to 4.5%, did you say as you at Bloomberg are predicting?
Yes, that's our
Okay.
prediction for end of the year.
Okay. All right. We're going to talk more about that in just a minute. Um, so, okay. So, sticky inflation. Um, do you think that the Fed is going to have to eventually abandon its 2% target because we have a new baseline? Or do you think it'll eventually get to 2%? It's just going to take a lot longer than the Fed is hoping for.
I think the Fed can get inflation back down to 2% in 2026, but not 2025 or at the end of this year. And I think also the Fed has been very clear that they are not going to abandon the 2% objective before they have actually arrived at it. And basically, you will need a wholesale facelift of the FOMC to cause the majority of the FOMC to want to abandon the 2% inflation objective before the Fed hits it. So my baseline is still for the Fed to stick to 2% until at least 2026.
Okay. All right. So we've got Powell, the captain, chaining himself to the wheel, saying, hell or high water, I'm getting to 2%. And he's got until his term ends in 2026 to do it. You think that that's potentially possible? All right. So let me throw a couple of potential curveballs here. So first off, we have at least right now, until he cuts, right? We have high for longer, right? And it might even become higher for longer if we get Trump and tariffs and whatnot, as you said, right? Like it's not inconceivable that rates could go even higher, but let's assume they don't. Let's just assume that they stay here for a good while still. Or maybe even, the Fed does a couple of rate cuts and we go from 5.25 to 4.75 or whatever, right? That's still a lot higher than the economy was habituated to, over the past decade plus, right? And where I'm going with this is lag effects, right? Policy acts with a lag, there's been a number of things that have maybe cushioned the arrival, maybe made the lag effect longer this time around, right? So there's all the liquidity that's been getting pushed out into the system, and we talked about the fiscal side is still doing its best to try to keep that going. We have corporate America very wisely, loaded up on the cheapest debt it could get when rates were still low, and the debt that's on corporate balance sheets is still, on average, pretty low, but increasingly that's coming up for maturity, right? So we have this corporate maturity wall that I'm sure you've heard about, but we've got trillions that are going to re-rate in the next couple of years, right? So what are your thoughts on, well, let me add one more data point here. I'm going to share a screen real quickly. So this is a history of the federal funds rate, right? I'm sure you've seen this chart very often. And you look at it, and it's basically a story of the Federal Reserve raising interest rates, relatively swiftly, hanging out, plateauing for a period of time, and then we enter recession. Of course, we don't know it at that time because the recession is declared, in arrears. But then, frantically cutting because it realized it tightened too much and held it there for too long. The lag effects arrive, and the Fed says, "Oh gosh, we're going into recession. We got to bring rates down," and that's preceded virtually almost every recession here, at least kind of in living memory. And you look at the trajectory we're on now, it sure looks a lot like the historical pattern, right? So, what level of concern do you have that lag effect may finally arise as we keep rates higher for longer and we repeat the same cycle that we've done many times? So, we go into recession.
Yeah, so you mentioned earlier that the birth-death model is very important in causing the non-farm payrolls monthly job gains number to be very high. And the reason why I want to talk about that is I think the Fed is taking too much signal on the very robust monthly job gains in
Mhm.
payrolls, and that indicator could be causing the Fed to stay high for too long. And if we look at the real-time birth and death estimate, so my team actually did this. We looked at real-time birth and death, And it showed that starting around July of last year is when suddenly the business formations really slowed and the number of bankruptcies started rising significantly. And I think that once all the revisions had been done on non-farm payroll, it would have shown that, in fact, the impact of higher rates for longer had already started hitting the labor market around the second half of last year. And that is just about the time that previous academic literature has estimated the lags of monetary policy to be. In the past, the estimate out there is monetary policy takes about 18 to 24 months to hit the labor market. So I think this cycle is the same as previous cycles, maybe just a slightly uh, slower with longer legs. However, at the end of the day, it's the same story. You have non-farm payrolls belatedly showing that in fact things are weaker than it seemed in real time. But because policymakers have to design policy with real time information, no matter how imperfect they were led to hold rates higher for longer.
Okay, I'm going to try to decode that a little bit to make sure I really understood it. But and it's fascinating that your own models, it sounds like, detected that the government reported jobs data is maybe materially enough inaccurate that it's akin to like a pilot flying by a faulty gauge, right?
Yeah.
So so if I understood what you said there, it sounds like you said, okay, yeah, the Fed's staying too high for too long because it's looking at flawed information, and then therefore you think the lag effects may slow the economy enough to go into recession or not? I don't want to put you into making a recession call if that's not what you're making.
Yeah, I think that right now our forecast is for unemployment rate to rise to 4.5% at the end of this year. And that would comfortably trigger the famous SOM rule for identifying a recession. And so based on that, that would indicate, a high likelihood of recession. However, to fully make this a recession call, one actually has to further have unemployment rate climbing um, to mid fives for it to be consistent with past recession pattern. We have the highest unemployment rate we have for next year is actually 4.5% still. So we're not exactly there yet. I think that the past 2 years has helped economists to be more humble about our forecast, and I think that there there is a chance that the SOM rule might be an exception this year in that the unemployment rate does not climb all the way by another 2 percentage point after it breached the 0.5 percentage point threshold. But nonetheless, I think that 4.5% unemployment rate would feel like a recession for most Americans. And I think regardless of whether NBER will declare a recession, in 2025 or 2026, it's really immaterial. It's the fact that most Americans would feel like the economy is in a recession.
Okay, so thank you for making that clarification because we can get a little bit wonky with what a recession means, and we saw the last time that we experienced sort of the technical definition by many accounts that we were being told, it really doesn't matter this time, right? And what really matters is what are the viewers of this video, what's their lived experience going to feel like? And I think I hear you saying, yeah, at 4.5% unemployment to a lot of folks, it's going to feel like a recession. Let me ask you, let me show you one more chart. So this is a chart of the unemployment rate. And you'll see, again, sort of like the federal funds rate, it tells a similar story over time, which is that unemployment goes down, 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 down. Everything's great, everything's great. And then it starts turning. And when it does start turning, bang, it goes up quite quickly, right? And generally, that's kind of right where the recession starts, right? So you've got employment spiking into recession, and that's a story again and again. I'm not going to look at COVID, but it happened in COVID again. But even in all these, prior sessions, that's pretty much how it works. So you'll see here, we're coming down. Now the unemployment rate is ticking back up again, right? And you think it's going to go up to 4.5% in a couple quarters. What is going to make this time different where it doesn't spike higher, right? What is going to, because it sounds like you said you go to 4.5 by the end of the year, but then you kind of stay there for another year. What is going to be different about this time?
Adam, just so you know, and just so the viewers know, our forecast of 4.5% is already one of the highest on Wall Street.
Yeah, and I applaud you for
Um,
it.
right? In fact, the Fed forecast showed that the median FOMC participant expect unemployment rate to stay at 4.0% this year. Um, and I believe the consensus Wall Street forecast is seeing it to stay at 4.1%. So, but to your question, what makes the unemployment rate just stay at 4.5 and instead of surging to 5.5%, which would be more consistent with the pattern in the past, 50 years? I think the key is whether immigration stops. So I think the reason why the Fed and most of Wall Street expect the unemployment rate to stay at 4.1% is that they think that the rise of unemployment is simply due to an expansion of labor force, not due to a surge of layoffs. And as a result, when you have a uh, increase in labor force due to immigration, you're actually increasing the potential GDP growth of the economy. So the GDP will also eventually grow faster as a result of the boost from the labor force. So in any kind of macro models, an exogenous positive population shock usually lead to an increase in unemployment rate only in the first uh, year or so, and
Mhm.
then the unemployment rate would decline thereafter as the economy, the potential GDP growth expand and the capacity of the economy to produce increase. So I think that's the story that Fed staff and the Fed is telling, and it remains to be seen whether that that would be what happens in the next couple of years.
Okay. All right. And I'm looking at my list here. It's been a great discussion. And the sign of a great discussion is that I'm only a couple bullets into a very long list here. So I'm going to start jumping around a little bit. Uh, uh, so one of the things that I talk about in this channel an awful lot, because the mission of this channel is to help out the regular investor. It's to help regular people build wealth, to be able to fund their goals in life. That's period. End of story. That's all I'm trying to do here. And so to have people like you come on and share their outlooks is very helpful for them. And in your case, I see you sort of waving say a yellow flag, saying, "Hey, folks, economy is probably going to start to get slower going forward from here. And especially if you work for a paycheck or you own a business, you should take that into account. Maybe your risk of getting laid off goes higher, or your business might have a little bit of a tougher time going forward. So start thinking about now how to adjust for that." Um, from a policy standpoint, I don't even necessarily want to get into the right or wrong of it, but it seems like whatever policy decisions that we have made over the past couple of decades, the end result is that the already wealthy benefit even more from those policies, and a greater and greater swath of the populace is getting further and further behind. And certainly what's happened post-COVID, and I'm not saying this was the plan, I'm just saying it's my perception of the outcome, is that cost of living went through the roof. You know, if you look at estimates of inflation, total inflation since January of 2020, Trueflation estimates it at above 25% right now. So essentially a quarter of the purchasing power of our money has vaporized in just 4 years. There's a lot of people that say it actually feels like more than quarter, but whatever. And all households experience that, but those who own financial assets and other types of assets, the price inflation of their assets has in many cases far exceeded that of the cost of living increase. So the wealthy they even noticed, in fact, they're better off and happy about it, right? But 93% of financial assets are owned by the top 10% of households, right? So the remaining 90%, who only own the 7% of financial assets, all they really get to experience is the injuries of the increased cost of living, right? And then, of course, if we go into a recession at some point, which obviously we will at some point, right? Uh, uh, the lower classes get hurt even more by that, right? And yes, wages have returned back to positive real growth, but that growth is slowing. And I think it's something like 2/3 of households, if you talk to, have said that their wage increases have not kept up with the increase in their cost of living. So where I'm going with all this is I see a trajectory here where the wealth divide is material and seems to be continuing to expand here. How much do you think about this as an economist, and what are your thoughts on it? Are you worried? Are you not as worried as I am for reasons I'd love to hear? What are your thoughts on it?
Yeah, this is actually an issue we forecast. We grapple with in our forecast. So I run a team of U.S. economists, and every day we're just trying to forecast what GDP, unemployment rate, Fed funds rate would evolve like. And I think distributional um, issues with respect to income and wealth actually does affect aggregate uh, demand, aggregate savings, and also ultimately the Fed funds rate in ways that are not immediately visible. So, for example, I think that there was a academic paper before COVID that showed that the increasing wealth inequality in the 10 years preceding the COVID actually drove the interest rate lower by a significant magnitude. And the reason why increasing wealth inequality would drive interest rate lower is that, the have-nots need to increase their precautionary savings when they don't have as much wealth. And as a result, then aggregate consumption would be lower than when if the inequality is not as big. And with lower aggregate consumption, firms also have less profit, and actually that over time leads to lower need to invest, and therefore invest in interest rate actually falls over time. So that's the mechanism of how wealth inequality could affect consumption and ultimately interest rate. So there has been a lot of discussion on Wall Street in the past year that the long-term interest rate is permanently higher, that the Fed is in this higher for long mode. But if you think about the economy from a wealth distribution perspective and with the mechanism that I just described, in fact, interest rates should be lower when you have widening wealth inequality, then I would see the argument for higher for longer interest rate, higher R star, as not as convincing uh, as most Wall Street participants sees.
Okay. Um, all right. If we can go just a few minutes over, I'm going to squeeze this question in, which is, let me ask you to take your economist hat off for a moment and just be a real person, a mom, a neighbor. Um, how what level of concern do you have about kind of where people's lived experience is going to head, say, over the next 10 years or so? with this wealth divide trajectory? In other words, do you see it getting worse and it's something that is going to manifest more and more in our society, or are you not that worried?
Looking forward in the next couple of years, now suppose that Donald Trump did win the election. That's one scenario which we could look at the inequality issues from. Well, Trump said he would impose tariffs, and typically tariffs would help the Rust Belt of America, and it should be helping the blue collars of America, the Detroit in America. So that should, I think, on the whole, be an attenuating force on this inequality gap. On the other hand, also, what would widen this inequality gap is asset price appreciation. As you mentioned, so much of the assets are concentrated in the hands of, just 10% of the most wealthy people who are mostly baby boomers. And so if the Fed had to hike interest rate in that scenario of, high tariffs, inflationary situation, then I think that asset owners would not see as much gains and that they would really be hurt from that perspective too. So what I'm trying to tell you, Adam, is that I could see clearly also paths where the inequality divide would not be just rising indefinitely.
Okay, and obviously, at least the financial wealth chunk is somewhat market dependent, or is market dependent. So I know you're an economist and you look more at the economic side of the equation, but do you have a market outlook? Because we started the conversation about NVIDIA basically being the single pole that's holding everything up right now, holding all the spinning plates. But it's kind of relevant to this wealth gap conversation as well, because if we, I'm not saying you would say this, but one could argue we have an overvalued market. If that market actually did correct, especially if we're going into a recession, which would bring earnings down and stocks would have to adjust downwards anyways, regardless of their current levels of valuation, that would bring financial asset prices down, and de facto that would bring things a little more towards balance in the wealth divide. So do you have a market outlook right now?
Yes, although I'm not supposed to be giving financial advice, but I would just give a general advice to, in terms of how I approach making forecasts, economic forecasts. Uh, one of the one of the key advisors for my group gave me a very good advice, I thought, which is that it's important to be able to live another day. So you don't want to be
Mhm.
wiped out. And I think this year what we are faced with is unprecedented uncertainty. The US election could lead to a binary outcome in terms of a lot of economic variables that we care about. It could lead to, it can be deterministic on whether the Fed will be hiking rates or cutting rates. It could be deterministic on how the geopolitical landscape look like in a year or two from now. And so I think that from a risk manager perspective, one should be careful about preserving capital in the current situation. And also just thinking about the history of stock market. If one buys in 19, I know there's this popular advice that says, keep investing, right?
Time in the market, yep.
Right, right. But if you did invest in the 1920s and also the dot-com bubble in 1999, you won't be able to recover your capital until long, long time later. I'm just saying. So it
Yeah.
really depends on your age group and your risk preference, of course.
Yeah. So first off, yes, nothing you're saying is individual financial advice. And I've got advisors that come on this channel that are on for that reason. So you didn't expressly say it, and I don't want to mischaracterize you, but it sounds like you're giving this advice of, hey, it's a time for risk management and to consider capital preservation because valuations are rich right now, and there is this high degree of uncertainty on a number of factors going forward, including, which of these two very diametrically opposed candidates is going to take the Oval Office in the fall.
That's right.
Okay, let me ask you this. This is just a thought exercise I've tossed out there, but I'd love to see if you have an opinion on it. It starts with the assumption that the current administration is doing what I think a lot of administrations do, which is doing everything it can in front of and behind the scenes to try to win the election, right? So I think, part of the reason for the fiscal stimulus that's going on right now, sorry, the fiscal spending that's going on right now, is to try to keep everything propped up so that they can, get reelected. You can make the argument that should Biden win in the fall, that his administration might say, okay, we've been doing these extraordinary measures to get reelected. We got reelected. We can't keep doing this at this level. Let's let the froth take itself out. Yes, the markets might come down, the economy might slow a bit. Yeah, we might have a rocky next year or so as we kind of let the froth get out of the system, but then we can recover and we can finish strong, right? We can have really strong years 3 and 4 and feel really good how we ended this administration. Same time, you could say, okay, well, if Trump wins, first off, the Biden administration's going to definitely stop doing what it's doing because they're moving out, right? And they don't want to help this guy at all. And I could see the Trump administration saying, yeah, let it clear. Yeah, we agree things got really kind of overheated here. Let it clear. I can blame it on the other guy for the first 2 years of my administration. And then I can repair things and finish strong in years 3 or 4. So it's kind of like no matter who wins, there's a selfish incentive to let the froth clear after the election. Is this just crazy talk, or does that make any sense to you?
There's actually a election mathematical equation that's consistent with what you described, which is the Ray-Fair election rule. And in the Ray-Fair election rule, which tries to predict the share of popular vote to the president, what matters is just the last couple quarters of GDP growth in terms of predicting the election outcome. So that's consistent with what you're saying. What matters in terms of the 4 years of a incumbent president is what really happens to the GDP in the last year.
Interesting. Okay. Wow. So there's actually a rule based on this. I'm going to go check that out after we finish the interview here. All right. Well, look, again, Anna, this has been a fantastic conversation. I'm really glad you came on. I hope you are having a good enough time that you'll come back on in the future. Let me ask maybe the most important question of the interview, which is for folks that have really enjoyed this discussion and would like to follow you in your work, where should they go?
They could go on Twitter or go to X. My X handle is Anna Economist, ANNAECONOMIST. Or they could go on Bloomberg Terminal if they have access to a Bloomberg Terminal. And my writings and analysis would be on the page BECO Go.
BECO Go?
Go. Yep.
Okay, great. So Anna, when I edit this, I'll put up your Twitter handle on the screen. I'll also put up the BECO Go code there or whatever, so that folks know exactly where to go. Folks, I'll also have links in the description below this video too, if you want to get to those with just one click. All right, Anna, I've got one last question for you, which I'm going to ask you in about 30 seconds. Just a quick bit of housekeeping beforehand. Folks, if you've enjoyed having Anna on the channel and would like to see her come back on the program again, please let her know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Reminder, I think we are now just about 2,000 subscribers away from hitting the 100,000 subscriber mark here on YouTube. So if you haven't subscribed yet, if you're one of the tens and tens of thousands of people watching this video, please do me a favor and just take a quick second to hit that subscribe button. It's totally free, but it will help us out a lot. And then lastly, as Anna said, she is not offering personal financial advice through here, but if you're looking to take action to position yourself for a type of future like Anna has laid out for us here, I highly recommend that most people watching this video do so under the guidance of a good professional financial advisor who takes into account all the macro issues that Anna and I have discussed here. If you've got a good one who is doing that for you and creating a personalized plan and executing it for you, great, you should stick with them. But if you don't have one, you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. These consultations are totally free. There's no commitment to work with these. It's just a free public service that these firms offer. All right, Anna. So the last question for you here is, you have a phenomenal work resume here. Bloomberg, chief economist for Bloomberg. You worked at the Fed, White House Council of Economic Advisors, U.S. Treasury. Remarkable. I hope you don't mind me saying this, for somebody of your age. A lot of the people I interview on this channel have a lot of white in their hair. You've accomplished an awful lot in your career so far. What's a big lesson you've learned along the way that you think is worth sharing with this viewing audience?
I think one of the biggest advice I could give is that uh, always look under the rug. And oftentimes, just when one is thinking that this piece of information takes too much work to examine, um, listen to that little voice, because oftentimes in financial markets, or in studying the economy, if you want to derive an insight, you need an edge, right? You need to be able to have an insight that other people haven't had yet, so that you that hasn't been priced in the market yet, and therefore you cannot ignore little things. And I think oftentimes in life, it's those little things which contain the clues to some really important insights.
Hmm. I love that, and it complements some other answers I've gotten on this channel, which is uh, to to read books and to read analysis that someone has spent an awful lot of time on to really get in and dig and understand the nuances. Because in today's, especially internet era, we read articles that maybe took somebody an hour to write versus a book, which might take a year, right? Or honestly, a lot of people just kind of skim headlines and then are taking their cues from that. And to your point, it's oftentimes in the little details, which is really where, the diamonds are found. So thank you. Totally agree with that. Well, Anna, look, this has been really just a pleasure. Thank you so much for coming on. And I hope at some point later this year, if your analysis is telling you anything, there are any material developments above and beyond what we talked about here, and you'd like to really amplify your flag waving of them out in the world, I'd love to have you come back on this platform and talk to this audience again.
Happy to do that. Thanks for having me, Adam.
Oh, it's been a real pleasure, Anna. Thank you so much. And everybody else, thanks so much for watching.